Welcome, traders. There's an age-old debate in our world: price action traders versus indicator traders. Which group holds the true edge? From my experience, this is the wrong question to ask. The real power isn't in choosing a side, but in understanding how they can coexist to create a formidable trading strategy. I remember when I started, watching others execute perfect entries while I was left guessing with just basic support and resistance lines. It was a frustrating journey, but mastering price action was the turning point that finally flipped my P&L from red to green. In this comprehensive guide, we will walk through 5 key pillars of price action trading. This isn't about Lamborghini promises, it's about building a solid foundation. So, if you're ready to stop guessing and start reading the market, let's begin. The first and most critical step is to understand the overall market sentiment. Never make the mistake of focusing solely on an intraday chart. You must zoom out to see the bigger picture. Let's take a stark example: a bank stock like First Republic Bank, FRC, during its decline. On the daily chart, you see a clear and brutal downtrend. It broke a key support level, formed consecutive lower lows and lower highs. Every small bounce was met with even stronger selling pressure. The sentiment was overwhelmingly negative. Now, contrast that with a strong stock like AMD. On its daily chart, it's holding above the crucial 200-day simple moving average, forming a series of higher lows, a classic uptrend. The sentiment here is bullish. The lesson is simple: trade with the trend, not against it. On FRC, you'd look to short the rallies. On AMD, you'd look to buy the dips. The bigger time frame is your compass. The intraday chart is your map. Now, let's zoom in and listen to the market's whispers through candlestick wicks. Wicks represent rejection and are key to identifying genuine breakouts and breakdowns. Look at Coinbase, Coin. At a key resistance level, you see multiple daily candles with long upper wicks. What does this tell us? Each time the price tried to break higher, sellers aggressively stepped in and pushed it back down. This is a clear sign of resistance and a potential false breakout, which can be a great shorting opportunity. The opposite is also true. At a support level, long lower wicks indicate that buyers are absorbing the selling pressure and defending that price. This is a sign of strength. This leads us to 2 powerful concepts. False breakouts. When price briefly pierces a resistance level but quickly reverses, trapping bullish traders. False breakdowns. When price breaks below support but swiftly recovers, squeezing out short sellers and launching a rally. Understanding these traps is how you avoid being the one who gets caught. Knowing the trend and the key levels is one thing, timing your entry is another. Let me share a strategic time frame that significantly improves reversal entries. Let's return to AMD on an intraday pullback. The stock is in a daily uptrend, has no bearish news, and is simply pulling back with the market. We wait for the golden reversal period between 10:30 a.m. and 11 a.m. Eastern Time. On the 5-minute chart, we see AMD find a low around this time, form a base, and then break out of its consolidation. It then makes a series of higher lows, confirming the intraday trend has reversed. This V-shaped recovery is a high probability, perfectly timed long entry. The criteria are strict: no fundamental bearish news. Stock is in a daily uptrend. Wait for the 10:30 to 11 a.m. window for a base to form. This disciplined approach prevents you from catching a falling knife and gets you in as the real momentum begins. To refine your entries further, you must understand the front side and back side of a move. Think of it as the difference between riding the wave and swimming against the current. The front side is the healthy, impulsive move in the direction of the trend. On an intraday chart, it's characterized by higher lows and higher highs. The price holds above key daily support levels and VWAP. This is where you want to be long. The backside is the corrective, counter-trend move. It's characterized by lower highs and lower lows. The price is stuck below a key daily resistance level, which was former support. This is where you look for shorting opportunities. For example, on a low-float stock like a BNB, if it breaks and holds above a key level like $11, Any pullback that holds that level is a front-side move, favor longs. Conversely, on FRC, once it broke below $20 support, that level became resistance. Every pop towards $20 that failed was a backside move, favor shorts. Don't fight the dominant intraday trend. You can master every technical aspect we've discussed, but without the right psychology, you will still fail. Trading is 10% technical analysis and 90% mental discipline. The market is unpredictable, and losses are inevitable. The key is to manage your reactions. Here are 2 pro tips. First, keep an emotional journal. Alongside your trade log, note how you felt. Were you anxious, greedy, revengeful? You'll start to see patterns linking your emotional state to your poor decisions. Second, educate your mind. I highly recommend books like Trading in the Zone by Mark Douglas for market psychology, and Atomic Habits by James Clear for building the disciplined routines that a trader needs. It's completely normal to feel angry after a loss, but with consistent practice and self-awareness, you can learn to detach your ego from your trades. This mental shift is what separates amateurs from professionals. And there you have it, a complete blueprint for trading with price action. We've covered the macro trend, reading candlestick wicks, timing your entries, identifying the front and backside of moves, and, most importantly, fortifying your trading psychology. This is a journey. Take these concepts one at a time, practice them, and integrate them into your strategy. If you found this guide helpful and want to build a stronger technical foundation, I have a free technical analysis crash course linked for you. Thank you for watching. If this added value to your trading, please like the video and subscribe to the channel. Your support helps immensely. Now, go out there and trade with confidence and discipline.